The market is calm, too calm. Stocks are hitting highs, investor sentiment is euphoric, and social media is flooded with people bragging about gains. But history teaches us that extreme optimism often comes right before the fall. Today, we're going to look at what the smart money is doing, why gold demand is skyrocketing, and how cash-heavy investors like Warren Buffett may be sending us a quiet but powerful warning. Hear what the CEO of Norway's sovereign wealth fund, Nicolai Tangen, says about today's market.
In a way, the world is splitting into two. And that means that we probably will see lower growth, and there is a risk that we will see higher inflation. And so the market is very resilient given that backdrop, I think.
So, which means that you're expecting maybe a correction, and are there parts of the markets that seem too sanguine at the moment?
Well, we've been saying for quite some time that we think it will be more difficult to make money going forward. And so I suspect with all the uncertainty that we are seeing just now, that we could continue to see tough times.
Let's rewind. In the late 1990s, tech stocks soared. The Nasdaq nearly tripled from 1997 to early 2000. People thought the new economy would rewrite the rules. But in March 2000, it all came crashing down. The dot-com bubble wiped out trillions in value. Fast forward to 2006-2007, real estate prices hit record highs. Mortgage-backed securities flooded the financial system. When housing cracked, it wasn't just a dip, it was a collapse, the 2008 financial crisis. Each time there were signs: overvaluation, euphoric sentiment, and smart investors quietly moving out before the storm. Today we see similar signals. Warren Buffett,
Right. Who's Warren Buffett?
through Berkshire Hathaway, is now sitting on over $150 billion in cash. He hasn't made a major acquisition in years. He's not jumping into overpriced markets. He's waiting. In fact, in his 2023 shareholder letter, Buffett said, "Opportunities come infrequently. When it rains gold, put out the bucket, not the thimble." But he's not catching gold yet. He's waiting for better valuations, which usually come after things break. Meanwhile, corporate insiders are selling at the fastest pace in years. IPO volume has slowed, and many major funds are rotating into defensive sectors or pulling back on leverage. Central banks around the world are buying gold at a pace we haven't seen in 50 years. In 2022 alone, central bank gold purchases hit 1,100 metric tons, the highest in modern history. China and Russia are leading the way, reducing their exposure to the US dollar and increasing their reserves in physical gold. Even retail demand is rising. ETFs, bullion dealers, and private vaults are seeing a surge in interest. Why? Because gold is one of the few assets that holds value in both inflationary and deflationary environments. Valuations. The S&P 500 trades at a high PE ratio. By historical standards, it's expensive. Debt. US consumer debt is over $17 trillion. Credit card delinquencies are rising. The Fed. Interest rates are stuck. Too high to stimulate the economy, too low to kill inflation. Geopolitics. Global instability from conflicts in Ukraine, the Middle East, and growing US-China tensions. Markets are priced for perfection, but the world isn't perfect. It's fragile. This doesn't mean you sell everything and panic, but it does mean you prepare. Diversify your assets, hold some cash or cash equivalents. Consider exposure to gold and defensive sectors. Avoid over-leveraged bets. Study history, follow smart money, and stay emotionally detached from market noise. In the words of Buffett, be fearful when others are greedy. The market might keep rising, or it might turn on a dime. Either way, those who prepared ahead of time always fare better. Don't wait for the crash to learn the lesson.